At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today. Good afternoon from our studio in Amsterdam. I just discovered a slight technical issue. For some reason, the comments page is not coming up. I told the technical team to work on that. So for those of you who are not familiar how the system works, if you find something brilliant or funny or you want to clap, there are 3 emojis at the bottom. If you want to pose a question, that'll be a bit difficult today because the comments thing is not loading. But what you could do is grab the mic after John speaks, and then I can add your screen to here and you can pose your question. But I'm hoping the comments part will be resolved shortly. So I'm thrilled today to have John Simon, who is one of the great thought leaders in the impact space that has been doing for actually quite a while. And he's going to share with us his journey from transitioning from the spice company OPIC to an independent advisor on impact investing. So, John, thank you so much for your time, and tell everyone who you are, what you've done, and what you're trying to do now.
Thank you very much, Robert. And it's great to see all of you, many of whom I know, some of whom sort of seen for the first time through the system. Of course, I want to thank Arthur Wood, my partner, for joining as well. And that's a big part of the story of who we are and what we've been doing. As you pointed out, for a period of time, I was the number 2 person, the executive vice president of the Overseas Private Investment Corporation, which at that time was the U.S. government's development finance institution. That has since had its name thankfully changed from OPIC, which was often confused with OPEC, the Organization for Petroleum Exporting Countries, to not the most imagined name, USDFC, but at least a name that's not confused with an oil cartel. So that's the U.S. government's development finance institution. It was at that organization where I first started to engage in what we now call impact investing. And at some level, a development finance institution is an impact investor from the outset. Development finance institutions invest not to make money. In fact, not only to make money. In fact, not primarily to make money. They invest to create a positive development outcome, ideally in a sustainable way that allows for a different type of model than just pure aid funding. And as we talk about this, and the theme of this talk is about maximizing impact with sustainable returns. It's about sort of impact first investing. I'll keep coming back to the idea that there are and always have been a large pool of investors in the marketplace for whom the primary motivation is not a higher return, but greater impact. And in fact, that's what's happened with us at Total Impact Capital over time, is we become more and more committed to this impact first approach. And in fact, the way we think about it, which is sort of the title of this talk, we're looking to maximize impact with sustainable returns instead of what I think most of this impact investing market looks to do, which is maximize returns, but with sustainable impacts. And we'll go into what the difference is there. And of course, those two things are both different than just out and out purely looking to maximize returns. So, having spent time at the outset, at the beginning of sort of this movement of impact investing, which of course got its name from a conference that was held in Bellagio, or where some of my colleagues attended in 2008. When I left U.S. government service, I was very interested in continuing this effort of driving capital into high impact opportunities. And I knew a number of other folks who were as well. Arthur Wood was one of them. He has been when we talk about thought leaders, has been one of the great thought leaders in the impact investing world. And you know, you can give chapter and verse on his resume in terms of what he's done in this space. We had worked together on an impact investing vehicle called the I Fund that funded eye clinics in the developing world. So he joined us. Derek Salibi, who had worked with OPIC on something called the Liberian Enterprise Development Finance Company, which was a SME financing vehicle designed to help support development of Liberia post-Civil War, joined us. And Michael Brownrigg, who had been one of the partners in ChinaVest, the original venture capital firm, U.S. venture capital firm in China, joined us. And so, you know, that was the creation of Total Impact Capital now a dozen years ago in 2010. And at that time, we fashioned ourselves as the merchant bank for impact investing. What we saw, and what I think was true, was there was a tremendous amount of activity in this sort of entrepreneurship space, looking to develop solutions that made the world a better place. And there was a growing amount of money, and I think this has continued since then, a growing amount of capital looking to invest in things that make a difference. But there wasn't the connective tissue to bring those things together. And that's what we saw ourselves doing at Total Impact Capital. And so, you know, our original iteration was really as what we called a merchant bank, you know, doing the banking work of bringing buyers and sellers together of high impact opportunities, largely with the idea that we weren't focused purely on transactions, but we're focused on relationships. We were focused on the long-term development of these opportunities. One of the challenges we found in that business model was the economics of working on a lot of early stage companies, especially in the impact space, where you don't necessarily have the next Google or the next WhatsApp. And again, we were focused on impact first, so we weren't even looking for the next Google or the next WhatsApp. Does make the business model somewhat challenging. So over time, we've gravitated to working less with early stage entrepreneurs and much more with organizations that have a track record of delivering impact, and they are trying to figure out how they can scale that with investment capital. And that's what we do now. And often the organizations we're working with are NGOs, like the Aga Khan Development Network or the Catholic Relief Services. Sometimes they're social enterprises like the water franchising company, Jibu. But in all cases, the idea is to start with what's the impact that they're delivering. Is that something that can be delivered in a financially sustainable manner? And then how can we drive investment into that to help bring it to scale? And in what we do, we find ourselves almost always using blended capital solutions to basically buy down the risk, because many of our investors, while they're interested in maximizing impact, they're concerned about losing capital, and so they need some credit enhancement. We often utilize technical assistance and technical services to de-risk the opportunities, and those make a big difference. We can talk about some of the results we've seen in terms of the solidity of the portfolios when you have that type of technical services support. And then the main point, which I sort of alluded to before, is we really focus on areas where we can partner with experienced groups that have an on-the-ground track record that we can help scale. I can go on and on a little bit about our model, but I wonder, Robert, if I should stop there and then pivot to talking a bit about our philosophy around maximizing impact with sustainable.
Well, I think what most people would like to know is, one, how are you able, or are you able to measure impact? Because you were saying you have investors that are worried about losing money. So, are you able to show them the impact that you're able to provide? And two, how do we scale up the money flows that's required? because there's lots of chatter, 50 trillion going into ESG, but that's not real.
Yeah. So, I'll agree with that. I'll talk a little bit about some numbers that are in the current space. But the fundamental point you made is if someone's looking to maximize impact, you need to be very clear about the impact you're delivering, and you need to have very robust metrics for the delivery of that impact. One of the things that we look for in the partners that we work with are folks who already have fairly robust monitoring metric frameworks and monitoring systems, and so that when we report on the impact they deliver, it's beyond question and something that has credibility with the investor and has and is the type of impact that they're looking for. And what we found is with our investors, even when we're getting relatively low returns, and of course until recently, if you were a fixed income investor, the returns weren't that great unless you were doing risky things like investing in frontier market debt. They were still thrilled with the opportunity because of the robust impact that they could report to their constituents. So, for instance, some of our investors are the pension funds for religious orders in the United States. Their members are very eager to see that their money does good in the world, and they were thrilled to see even when they were only getting 2%. They were thrilled to see the results that were happening. For instance, from our water fund that was delivering a high, was helping to finance water improvement, water access in Central America. So it is absolutely the case that if you're in the world of trying to be impact first, maximizing the impact, you have to start with a very clear, robust metric system that people can have faith in. And part of what we're working on now is, as we have multiple vehicles in different areas, how do we aggregate the different impacts into a way that investors who invest across the various vehicles that we're working with can sort of easily and simply see the different impacts that their money is achieving.
So you've gotten some institutional investors for your merchant bank. And I'm sure you see loads and loads of great opportunities, but might be a bit too early to, or just not the right fit. How are you, finding the opportunities? Because I often hear from investors, oh, there's no deals out there. And I ask them, where are you looking?
Yeah, so it's a very good point. I mean, when we started out, we hear that from investors all the time too. And I think there is some truth to it. It's not that there are no deals out there, because when we started out, we saw so many different entrepreneurs that had, like I say, exciting, creative ways to make the world better. But, they were very risky, very early stage, not something that someone who wanted to achieve high impact, but not necessarily put their principal at risk would be willing to invest. The issue isn't that there isn't a lot of things to invest in that have impact. It's difficult to find things that have a proven track record that you can have confidence in. To invest in and invest in at relatively low risk. Where we find the opportunity to do that is working with established partners. So when we have a NGO or a social enterprise that has already spent years or even decades delivering clear impact, so that's the first question: are they able to deliver across the first hurdle of delivering something that's really meaningful for the world? If you're working with an organization that has decades of doing that, you answer that question, and then you're able to build on the sort of portfolio they already exist to show investors that while it's not necessarily going to be something that's going to get a 10x or 20x return, it does have very low likelihood of losing money because, for instance, in the water sector, people will pay for their water. And what we found is, for instance, with our water financing vehicle, Azure Source Capital, at this point, 4 years in, $7 million deployed, we've had one late payment and no defaults, no workouts, no restructuring. It's actually, I'm sorry, one other restructuring. But that's because of three things. One, as a general rule, people will pay for their water. Two, when you have the technical services that are applied to the underlying borrowers we work with, they identify all the ways that you can avoid being unable to make the payments. And three, when the customers get better quality, more consistent water, they are even more willing to make the payments. And so what we found is, if you are delivering, to some extent, one way to de-risk an investment is to make sure you're delivering something that people value. And there are very few things that people value more than water, food, health, education, things of that nature.
How would you compare yourself to a DFI? I mean, if anybody's ever tried to raise money from DFIs, it's like having your fingernails pulled out.
Yeah. And it's something we do on a regular basis. So I don't know how many nails I still have left. So it's an interesting point, because I did work at a DFI, and when I thought about what the world needed in the impact space, I was thinking that it was an organization that acted like a DFI, but was a little bit more impact oriented. I think there are a couple of big differences or ways that we would want to differentiate ourselves from a DFI. One, right now, we develop, arrange, structure the deals, and we go to the DFIs to fund them. Over time, we're looking to create our own financing channel that will be able to help these vehicles scale without the DFIs. The DFIs operate in very risky environments. As a result, they have developed mechanisms to reduce risk, but those mechanisms also create a lot of burdens on the underlying borrowers. Part of what we want to do is figure out a way to streamline those burdens, to free borrowers from that. And of course, the DFIs, as a general rule, right now, are looking to deploy larger and larger amounts of capital, which means that a lot of the high impact opportunities we operate in tend to operate below a lot of the DFI minimum thresholds. And that's something else that we see as a challenge to be overcome, a challenge, but also an opportunity, where if we can create a financing structure that can help these types of high impact organizations get to scale to a point where they can attract even more DFI money, we can fill in that gap.
And do you also approach, like, the Gates Foundation or other large endowments like that? Because personally, I'm not particularly a fan of philanthropy, because it's only using a small percentage of the capital. And so I want them to use 100% of their money, not 5%, which is subsidized by taxpayers. So do you engage them, and are they willing to listen, or they say, nah, we just want to do endowments?
No, we do engage them, and they have invested in some of our vehicles. I do think it is important to recognize there's sort of different segments within the foundation world. So to be clear, right now, most of the vehicles we work with get financed from three major sources. One is the DFIs, one are foundations, and they're, like I said, I'll describe the different flavors of foundation we tend to work with. And then one are impact oriented vehicles, like, for instance, Calvert Impact Capital, that are created basically to channel money into impact. In the foundations, you do have this bifurcation between the massive foundations, the Gateses, the Hewletts, the Packards, the Fords, the Rockefellers, and a lot of smaller family foundations. We tend to find the family foundations are much more flexible, and we see a lot more money coming from them. And many of those family foundations have actually made the commitment to 100% for impact, which I'm sure you're aware, Robert, the movement that Charlie Kleister founded with his own family foundation, to say that everything that is in their portfolio should be oriented towards their mission, whether it's a grant or investment. So that movement, has great traction, and you do see a lot of the mid to smaller size family foundations are committed to that. But occasionally, we do things that align with the larger foundations. We do find investment from them as well, and all of the larger foundations, Gates, Ford, Rockefeller, Hewlett Packard, MasterCard, recently, they're all at Visa. They all have dedicated impact capacities. So they're all looking to put more money into impact investment, but not, like you say, 100%. It's still, some small fraction of that, in addition to the 5% they're legally required.
And do you approach family offices for funding, or do you say, oh no, this is way too risky?
So right now, like I say, the three groups that we tend to get financing from are the three that I mentioned. We're seeing more interest from family offices, and many times a family office and a family foundation are not too dissimilar. Where we see the opportunity to broaden the aperture of investors are with wealth managers who have clients who are very interested in impact and need a product that is relatively low risk. That's a big challenge, as much of the impact product that's out there is either high risk or very illiquid. Donor advised funds, many, donor advised funds are ideal for impact first because the money's been given away already. So the returns only benefit the fund. They don't benefit the fund's owner, the fund's sponsor. And so there is a real opportunity to say, look, if you've given this money away to create impact, here's an impact first opportunity that will really make a difference. And then we're seeing more interest from corporates and, like I said, institutional investors that have impact set-asides that are looking to put their money into high impact opportunities.
And I mean, normally, if you look at the amount of money that's claimed that we have to kind of retool the economy, whether it's your focus in the emerging markets, they're talking of massive sums of money. And yes, China will put lots of money in Africa, but in infrastructure, and they're not going to fund SMEs. And the DFIs are so slow to move anywhere. How do you speed up these money flows? Because there's 4.6 times more wealth than there is GDP, so there's no shortage of cash. How do you speed it up?
Yeah, so I agree with you. There's no shortage of cash. I think it is the sort of channels to converting that cash into viable projects, viable investment opportunities. And like I say, our solution, and it's not the only solution, I think there are lots of other solutions out there, is really to leverage the folks who are doing this work today on the ground. There are thousands of organizations that already have a track record of delivering impact. If many of them are doing it in ways that generate revenues. If we can channel money into those, and again, in many cases, that's not going to be your double bottom line opportunity. It's going to be opportunities where the returns are relatively modest, but nonetheless, if you can channel money into those opportunities, that's a way to make a real difference. And that's really where our focus is how do we create mechanisms and products that can channel money into the people who are already delivering impact and just need more fuel in their engine, more capital to really achieve scale.
So what are your focus or your sweet spot of industries? Is it like energy, education, transportation?
Really, the way to think about it, it's the first 8 SDGs plus SDG 11 and 13. And for those who don't know the SDGs, they're the Sustainable Development Goals. There's 17 of them. They were sort of ratified by the UN in 2015. They're supposed to be achieved in 2030, which gives us a very short amount of time to do that. But the first number of those SDGs, number one is to make progress against poverty, which I think everything that we look to do, we're trying to do. But number 2 is to address food. Number 3 is to address health. Number 6 is to address water. Number 5 is gender. And basically, those are where we see really high impacts that we can support with capital, and where we see folks who are making a real difference on the ground that can get the type of financing that we're looking to achieve.
Do you manage your own money? Do you have a fund, or is
we do both. We raise capital for other people's funds, and we structure funds that we manage ourselves. So we, for instance, manage Zero Source Capital. We manage the Franchise Impact Solutions facility. We are about to bring a new fund to market very shortly. It'll have its first close in the next, probably by the end of February. That will manage in the clean cooking, clean water space for where the revenues come from carbon credits. So we do both.
And when you do you approach? You said you were working with some faith institutions. Are any of the large pension funds in Europe who they talk a lot about all their impact, but when you pull up the kimono, there really is not much there. Do you get are they happy to meet with you and write you a check?
Yeah, we not to write us a check yet. I mean, so like I say, we don't live in the no trade-offs world. And I think
What does that mean? What does that
so,
mean?
so there's a part of the impact investing world which says we invest in things that are supposed to be both high returning and high impact. And I don't dispute that there is a place where that happens. And certainly we'd be thrilled if some of the things we do would do that, but we're not trying to look for that. We're trying to look to maximize impact first. And if maximizing impact can result in a modest 2, 3, 4% return, we're willing to see if we can find investors to make that happen. And what we found is, in fact, there are investors who are interested in that type of proposition, provided they have a fair degree of confidence they won't lose their principal. And so it's not the largest part of the impact investing world, but we think it's a part that has been shrinking in the past, but could be growing if people had the appropriate product. So let me just give you a few numbers on this. You know, the GIN does a survey every year, the Global Impact Investing Network, of the various vehicles out there and what type of return expectations they're looking for. And they break it down into 3 categories: market return, close to market, and capital preservation. And really, most of what we do is in that capital preservation bucket. And in 2014, 55% of the vehicles were market return, 20%, 7% close to market, and 18% capital preservation. Now, with so many of the sort of large scale asset managers, the TPGs, the Bains, the KKRs coming into the Apollos coming into the mix, you know, that market return number is now up to 67%. The close to market is 18%, and capital preservation is just at 15%. But our view is that means that there's a real opportunity to offer that type of product, because we think, and our experience has been, there are lots of investors who are looking for that capital preservation, high impact opportunity, but aren't able to find it. And so, you know, in the history that I talked about, you know, we raised money for lots of different types of enterprises and funds. It's raising money is always a challenge. It's never, ever easy. But it's certainly a lot easier for us when we have a high impact proposition that isn't claiming to be, you know, a market rate opportunity than it is when we had things that were high impact, supposedly high return, but also invariably high risk. And I think if there's an unmet appetite out there for high impact, reasonable or modest return with low risk, and that's the space that we're trying to find it. And one thing we find is, you know, if you're coming to the market with an opportunity that's claims to be high impact and also claims to have a high return, you're met with a lot of skepticism on that return number. I mean, people will say, you know, really 25, 30, 35%, you really can achieve that, or 3, 4, 5x. On the other hand, when you come to the market and say, look, we have an established organization that's already got decades of experience delivering impact. The impact is absolutely clear, and we're only looking to deliver a 3 or 4% return. You know, a lot of people say, well, that actually seems like something you can do, and we're willing to put our money into something that can derive that. Of course, that was a lot easier when interest rates were negative, or in Europe, or 1 or 2%. Yeah. Now with rising interest rates is a bit more challenging proposition. But my own view is the concept of investing for sustainability as opposed to maximize return is still a valid one. And that there are investors out there who say, look, if you can get the most impact and do it in a sustainable manner, and if that means, you know, 2 or 3%, we're still willing to take that.
But offering 2 to 3 or 4% when interest rates are above that doesn't seem like a winning proposition.
It's certainly something that's being tested. Now, I would say we have 2 deals that are coming to close in the next few weeks, both of which where investors are getting, well, in one case they're getting 6%. So they're getting sort of something that's, I guess, closer to a reasonable spread above treasuries. And the other deal, they're getting 3%. I mean, I do think that there are investors for whom, when they think about the long term, they're comfortable with the idea that inflation won't be at, you know, 7, 8% forever, that it will come down to a more reasonable level. And as long as they're beating inflation, that they're comfortable getting that return.
Don't you get frustrated, irritated, pissed off by the steaming piles of horse shit of people pretending to be impact investors when they're just unicorn hunters?
Well, so from my perspective,
Because you're always quiet.
anger.
I mean, maybe behind the scenes you're
Yeah,
screaming and yelling, but every time I speak to you, you're quite, chilled and politically correct.
yeah. Well, anger is not a very productive emotion. I do think, as an industry, we need to be careful of the impact washing, greenwashing, however you want to call it. I mean, if it's I remember listening to one of the no trade-off funds talking about one of their great investments, which was a gym in an inner city. Now, if you went to these gyms, I would doubt you'd see a lot of inner city folks, using it. The gym was in the inner city, but the customers were, yuppies like they are at any gym. And that's my supposition. If someone's from that fund, they're free to challenge me in this. But if the story of impact is, look, we've produced a lot of inner city gyms, we're going to have a tough time as an industry. If the story of impact is, look, we've delivered clean water to millions of people. We've delivered healthcare to millions of people. We've reduced emissions by billions of tons. Then that's going to be something that people will continue to want to support. But the concern about greenwashing, in my mind, is not sort of one of being jealous or angry. It's really one of, what does it do to our industry as a whole? And I think, like any industry, we have to set standards and hold all the people who claim to be part of our industry up to those standards. And I have no problem with someone who can show us that they delivered real impact and also got a great return. That's fantastic. That actually is a good thing for our industry. But if it's a bogus impact and a great return, then that's a real problem.
But isn't that, I mean, the Bloomberg claims there's 50 trillion going into ESG. If that was really true, there'd be no problems with climate change or anything like that. So it's not going in there. It's really, as I always said, it's a membership card to a fitness club, telling everybody but never going. Mm-hmm. So you say it, that needs to be addressed. How does it need to be addressed?
Well, so I do differentiate between impact investing and ESG. We're in the same family, but we are very, 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 very different. And remember, right now, ESG is under serious attack from the right. And so I would be very wary of feeding that attack, because I think it's incorrect. I mean, my own view is we should be looking at markets, we should be looking at corporations, we should be looking at market participants to be part of the solution for our problems. And ESG is theoretically, on paper, one way that markets can help supply our problems. The challenge with ESG is the metrics are still relatively soft. So what we need to do on the ESG front is come up with much more rigorous, much clearer, much more defensible metrics. And then you don't have the situations where you have sort of ESG portfolios that include, for instance, Exxon and Chevron and folks like that. So I do think there's a lot to be done on the ESG front to clarify what truly is good environmental, social, and governance approaches by corporations and what's not. And the more we do that, I agree with you, the more likely it is that corporations can be part of the solution, not part of the problem, multinational, large corporations. I think on the impact front, it's very important for us. Well, I think a big part of solidifying the growing interest in impact is making sure that what we lead with clear impacts that people can touch and feel proud about being part of. I mean, it's absolutely the case that most of our investors invest with us because they get an emotional reaction to what we're able to achieve. And I think we have to start with that of looking for investments that really generate. Yes, I'm thrilled to see these people getting clean water. Yes, I'm thrilled to see these people getting healthcare. Yes, that's something that really is making a difference that I'm happy to be part of, even if it's in a very small way.
But there, I hear you, and I agree with you on that. But because we do a lot of our work is raising money, and I remember one of our clients was the leading regenerative agriculture company in the world. They were at Series Z, raised lots of money. And I introduced them to a family office that claimed we're really keen on impact and agriculture and regenerative agriculture. So they, tell them we increase the yield 5x, we increase soil concentration of CO2 300% through biological treatments, we increase longer shelf life, etc., and we basically get these people out of poverty. And then the family office, which has big on their website, where regenerative agriculture and impact, they ask them, well, what's your business model? And I have to say, I'm sorry, it's a goddamn farm that makes XYZ. So I see a lot of the impact washing also going on in that space. And I'm glad that you find people that are mission and purpose driven. But I see the same thing within that space, because the ones really doing the most, they talk the least, and the ones doing the least talk the most, and people chase the press releases.
Yeah, I guess the way I sort of think about how to deal with that is going back to the fact that we have to make sure finance is the tail, not the dog. And and what we need to do first and foremost is recognize that we're bringing, like I say, fuel to an engine that should be built by people who've already established their bona fides in terms of what they're able to do in terms of impact. And I think part of where we may run astray is when we get too enamored with our financial engineering, we forget the underlying substance of what it is. We are form. What we have to focus on is function, and we forget the underlying substance of what we're trying to do, which is really the most important thing. What makes our vehicles work is the fact that there are better ways to deliver water or better ways to deliver healthcare than what's currently being done. And we work with folks who figured that out and have been doing that for a long, long time. And so, what we're coming in is not to change that. It's just to figure out a way to make that, to like I say, provide more fuel to the engine to make that something that can be scaled to more and more health facilities, more and more water cooperatives, more and more farming cooperatives if you're in the food area. I mean, it is one thing that I think is absolutely true, and certainly in the agricultural space, this is the case when you think about what climate change has done to traditional farming practices. There are a lot of ways to improve what we're doing, what anyone is doing in terms of their impacts on the planet, in terms of their impacts on the most underserved population. So going to your point before about, are there deals out there? There's no shortage of ways to do that. We just have to find the folks who have figured out how to do that and give them the resources to really do it at scale.
Do you only focus on Africa?
No, Africa and Latin America. And we'd be willing to focus in other regions, and we have in the past, based on where our partners are. So the sort of determinative element of where we work is where there's a group we can work with who's already achieved the type of impact we're looking to scale.
Okay. Because as I said, there seems to be a technical error about putting comments. I'm going to invite one person on stage to pose their question who's never a shortage for words. Your buddy, Arthur Wood. I don't know if it's going to work, but we'll see. I think he's a bit shy this time because he doesn't want. I don't think he wants to come on stage. So, oh yeah, there he is.
Well, if you want, Robert. Hello, how are you, John? Good afternoon.
Good to see you, Arthur.
Okay, can you concur on everything that he said?
I always completely concur with what John said. So yeah, we're on the same page. I think I may be a little bit more skeptical about the greenwashing that I think is going on. I read the Convergence report recently about blended financing models that said it's basically going down. I look at things like the Phoenix report that said the market is in decline, and I have a big difficulty in squaring that with literally trillions that I hear have been mobilized in the course of the last year or so. Theoretically, if you leave everything, this market has grown at a compound rate of 60 to 80%. Now, anybody since 2011 and indeed from 2018, and anybody that works in finance will take with a deep log of salt a 60% to 80% compound growth rate over 10 years. It's not to say there's not some fantastic things going on, and John's talked about them. But one of the dangers I see for our sector is the extent to which we overhype what we're doing and not delivering exactly what John is talking about, maximizing impact with sustainable returns. So yeah, I'm bullish on the market. I think we're in danger of overhyping that, and I fear the political reaction to that, specifically in the context of the Abrage documentary last night, is that you see a reaction from some of these organizations arguing that money should go the old traditional route. And that's a real danger I see for our sector. And we've really got to focus on real clear value where it's being created in. It is exactly the point you made, Robert, and exactly the point John made.
I agree 100%.
Thank you, Arthur. Thank you, Arthur. I'm going to pull out the hook from the stage. John, what's the difference between what you're doing and water.org?
Well,
Damon's Club.
I mean, we actually work with water.org in certain instances. I mean, one interesting thing about the impact space, and, time will probably differentiate this, but I think this has been true for the 12 years we've been active in. There's a lot more opportunity to collaborate than compete with a lot of your partners. So, one group we do that we work with that also does a fair bit of the same thing we do is Calvert Impact Capital, and yet they're an investor in several of our vehicles, and they in fact helped us get started. Water.org has a certain model for delivering access to water that is complementary to what we do. We tend to work with communities at the community level, building infrastructure like tanks, providing micrometers, pumps, things of that nature. They finance the sort of connections for new households into existing systems. Obviously, if the pumps and the tanks are decrepit and aren't working well, a new connection isn't going to be that effective. So these are two things. These are two sides of a coin that both need to be part of the solution. And yeah, in my experience, our industry is still sufficiently nascent that the opportunity for the players to work together is much greater than the need to compete.
Okay, I'm going to invite an entrepreneur who actually does an African education vehicle, Andrea Pizziconi. So I don't know if you bumped into her.
Yeah, I know. It's good to see you, John. It's been a minute.
Yeah, a little bit more than a minute. I'd say several 100,000 minutes. But great.
Yeah, but it's nice to see, and it's nice to see, it's nice to see how your philosophy is not, it hasn't evolved, but it seems like it's deepened down, like you've kind of, sunk in your anchor in your position of the impact that you want to make. And it's great to see, people like you that are coming from a policy background and a government background, kind of use your social equity for good, which is your relationship equity and your understanding of institutions inside and out. So it's fun to see that. And so, Robert, do you want me to make a different comment?
I'm curious, John, would you invest in Andrea's vehicle?
Well, I certainly have invested in the vehicle I knew 7-8 years ago. I want to know what the I mean, education is a basic human need, and absolutely, it needs greater finance. And so, yeah, the real question is what Andrea is doing lately, which I don't know, but exactly. I certainly would have invested in what we talked about years ago.
Well, I think that it would be an interesting question, John, to the extent that you talked about how you're not in the camp of, there's no trade-off. Like you've stated very specifically what part of the ecosystem you're focused on, which is lower returns, higher impact. And I think that what John knows about the Africa Integra side, he doesn't know about Girls First Finance. And so this is an interesting pivot because it kind of is a case study in what you're talking about. So we ended up having an insurance payout from DFC on our Ghana project. And our investor made more money for walking away than finishing the buildings, which was a massive moral hazard. And so it was like from an impact, what we talk about impact washing, this was a blue chip institutional investor that did the calculation and said, finish the buildings, do the right thing, make this much, walk away, get the insurance, make this much. And so it created a whole moral quandary, which to a certain extent is, it validates your thesis about, being discerning about who you want to work with in the impact space. We took our blood money from that and we created a new venture called Girls First Finance, which focuses on providing student loans for the girls in Africa who are sexually exploited to pay their school fees, which came out from this whole project when I was embroiled in a sex scandal and accused of sleeping with somebody to get the deal done, blah, blah, blah. And so, it's pretty colorful. But to your point, we have found that now in Girls First Finance and in providing student loans for girls, that skepticism that you're talking about, or that sense of, well, you can't be doing good if you're making a sustainable return, it begs an interesting question, because when you're trying to provide impact at the scale that millions of girls need because they're not getting student loans, and the alternative is that they sell their bodies, you can't bring enough capital into the market if you don't have a competitive return. And so what we found when we looked at the ecosystem is that the governments and a lot of impact investors were crowding out the commercial space of providing loans by saying you shouldn't have an interest rate that's over this because it's unethical. But they weren't thinking about the fact that the girls were otherwise trading their bodies to get money to go to school. And so it's like, 15% interest rate versus 8% interest rate doesn't really change a life, but not getting a loan because you can't get the 15% interest rate and then having to traffic yourself. So what would you do in that kind of situation? What would you say?
This is a debate that the microfinance industry has wrestled with for a long time. And there are a number of very highly regarded microfinance institutions that have done a lot of good in the world, but charge not 15%, but 20, 30, 40, 40%. I mean, the most expensive dollar is the one you don't have. So you have to do that analysis of why are we charging 15% and what's the alternative, as you're pointing out. And the flip side is, if you're trying to maximize impact, what are the opportunities? What's the trade-off if we go to 10%? Do we, in fact, are we unable to do more? Or are there a group of investors who'd be willing to finance us at if we charge 10% and still achieve the same scale? I definitely push back against the idea that just because something creates a high return or has a high interest rate, by definition, it can't be high impact. I think there absolutely is a no trade-offs world. I guess what I'm reacting to is the idea that the only impact investing worth doing is the no trade-offs world. I think there's a lot of impact investing that's worth doing where the returns are more modest, but they are sustainable and they are enough to attract sufficient investment to get to a level that makes a difference. I mean, there are some instances where you're not going to get to the level you need without a higher interest rate. There are other instances where we're oversubscribed and, we don't need a higher interest rate. We need, to build the capacity of our partners so they can create more projects, create more underlying borrowers. So, I mean, we have a vehicle that's going to close in the next few weeks where the sort of equity layer has their return capped at 12%. Now because if you look at the carbon markets, and this is in the carbon space, it's very possible they could do much better than that. But those investors said we feel better. We're more willing to give our money with a cap, knowing that anything that's excess goes into the community, than we are getting the last basis point out of it. So it's not that there's anything wrong about being in an environment where you're getting a good return and a high impact, or about having an interest rate that is in the double digits, when in fact that's what's required to deliver the highest impact you can. It's just, it's also true that there can be situations where a lower rate can still achieve that type of impact, or where you can deliver impact that investors would be interested in, and not necessarily be at the double digit level.
So tying it all in a nice bow, Robert, if I may, because John, I think that the one thing that you might be also underselling in this thesis, which is the timing, and you said it a little bit earlier in your talk. So the end of the case study is that we were approached by Porticus Foundation, and they, in essence, became a high risk impact investor, to the extent they were like, we want you to double down on your impact, go for even more vulnerable girls. We're going to give you free money. But what we require is that you really deepen your impact. Don't go for the middle class girls, go for the super poor girls, and use this free money to build a better mousetrap to attract other commercial investors later. But it came down to, and this is where I think the folks like you can make the most impact, is by curating the investors that are saying, we'll take that lower return, we'll be this part of the blended capital stack. Like to scale, you need the guys that want, this return, but the ones that want this return are willing to take that higher risk that will transform the business model from the impact washing or impact light to impact deep.
Yeah. So in our model, you definitely need the folks. And like I say, almost everything we do has a blended finance component, which means someone's taking, in essence, a concessional return, even a lower return than the return that I was talking about. But the investors that we tend to target with our product, the ones that we're looking to scale, are the ones who want lower risk and are willing to take lower return for that. So there's, it's not a simple world. There are lots of different folks out there that have different appetites. What we have found is there's a large pool of capital that has the appetite for less risk but higher impact, and as a result, doesn't necessarily need a higher or what you would consider a market rate return.
And they all play their role. All of these kind of impact return, they all play the role in the ecosystem of making the good deals happen.
That's absolutely right.
Yeah. Well, nice.
Oh. Thank you, Andrea. Sorry, I had to pull the hook out here because I promised John to actually end on time because I think he has a meeting with Kevin McCarthy advising him on how to make a bigger mess than he already has.
Not these days, no. Yeah. I mean, I would make a point, Robert, just to go back to that ESG. Like I say, there's a lot to criticize the ESG world on, but we are actually facing an assault on ESG from some of my old friends who I think, and I think it's largely a disingenuous assault. It's largely because of concerns about, ESG policies discriminating against fossil fuels and promoting sort of woke policies at large firms. And from my perspective, that absolutely turns on its head classic free market thinking. Classic free market thinking says markets and the market participants, which includes large corporations, are part of how you get good social outcomes. They're not the opposite of that. And if I do believe if this assault against ESG is successful, impact investing will certainly be next. And to Arthur's point, part of our defense has to be that we have high standards. We stand against sort of greenwashing. We focus heavily on making sure people who talk the talk walk the walk. But we can't be oblivious to the fact that there is this political assault happening that I think is something we as an industry do need to rally to the effect.
I really wouldn't worry about that. I mean, I know a lot of people don't know we were once attacked by the pre-MAGA Republicans. I think it was 2003, 2004, by a guy named Steve Malloy, who used to support the tobacco industry, saying that it's not a problem for cancer. He would support the oil industry. It's not a problem for climate change. And I invited him because he started an anti-ESG fund. And I invited him to come speak and be on a panel. And he saw who was on the panel. He said, I'm not coming if he's on the panel. I said, okay, that's fine. And he started this campaign of targeting my sponsors. He targeted the speakers, and the speakers and moderators were very civilized, and they would actually listen to him. And, all this kind of threat. And in the end, the guy was a punk. And you just, say, just kind of stand up to these punks. Florida and Texas, so they're going to have a period of time we're not doing it. It's not going to change the money flows in the direction. No one is looking to, let's put more money into things that make things worse or that increase climate change. So I'm not really bothered by it, but you do have to confront the punks. Getting back to you, what can this audience that's watching live now and those that will watch the replay do to help you?
Well, I think a few things. I mean, I think if folks have exciting opportunities like Andrea is talking about, I'd love to hear what are the opportunities to maybe craft products that fit the model, the sort of box that we operate in of high impact, low risk, reasonable return. So certainly, looking at this audience, I imagine that there are a few folks out there who are doing the types of things that could really be structured in a way that would be attractive to the investors that we're working with. Certainly, I think, Robert, what you're doing and making sure that the news of the opportunities at this end of the spectrum are broadly shared is absolutely vitally important. I mean, I think as an industry, we need to, there are some folks in our industry who are very good at telling stories, as Arthur was talking about, and there are others who sort of put their head down and sort of get things done. And I think we need to give a lot more voice to that latter group. And lastly, I think, as an industry, we need to be very diligent about setting high standards for impact and making sure that the folks we view as our peers actually meet those standards.
And with respect to, are you looking more for deals or are you looking more for investors?
So first and foremost, we're interested in partners, and partners translated to what you call deals, but we think of that more as long-term relationships. But we first and foremost, we're looking for partners that have a dedicated track record of impact, a proven track record of impact that needs capital to scale. That's the first thing. And then I think, like I say, we have a lot of interest in the product that we're putting out there. Certainly, but you can never need less interest. I mean, the more interest we have, the more likely we are to get those interest rates that'll be attractive for our partners to be able to deliver the services they have at the most affordable price they can. So we're also very interested in people who are interested in investing in this type of model. And yeah, absolutely. Among the folks who are hearing my voice, if you fit into either of those categories, we'd love to talk to you.
And what is your specific sweet spot for partners, or what I call a deal?
In terms of, you're thinking in terms of size?
Yeah.
I mean, as a general rule, what we found is a $5 to $10 million starting proposition that then can scale up over time into the 20, 30, 40, 50 million. That's really where the sort of step function we can operate at. So to the extent that people have models that can sort of get to the next step with a $5 to $10 million investment, and then look to scale beyond that with another 10, 20, 30, that would sort of work for us.
Okay. Where we send out the link to the replay, it takes about an hour or so to process, and I'll give them a link to your website. If there's any document reports or anything that you want me to share, just send me a mail or in WhatsApp, and I'll include that in the message, and then people can reach out to you from the information that you sent. I just want to take a quick group selfie to actually prove we were doing something today and not hanging out at the bar with Arthur getting drunk. So I want to thank you so much, John, not so much for talking, but also keeping it real, and that sticking to the values of what's really important, what you're really trying to change. So thank you for that. I want to thank our entire production crew for making this webinar possible. Sam, our producer, crypto genius and ramen critic. Ricky, my absolute better half with no filter. Xi Jinping, our head of transparency and integrity. Vladimir Putin, our military strategy and human relations advisor. Elon Musk, our humility coach. And Kevin McCarthy, the Dale Carnegie Prize winner of How to Win Friends and Influence People. So thank you all very, very much. I'm going to run a short mixer of 3-4 rounds after this. John, you're more than welcome to stay.
I do have a call, but it'd be great to do that. So I hope it goes well.
It will. All right. Well, I'm going to end the photo, and then we'll go right into the mixer. And John, thank you so much, not only for doing this, but also for the work that you've been doing.
My
and just for those who want to join the mixer, just stick around and. All right, save that. Okay, that. Okay. See you all.